Today's topic, 10 personal finance rules they didn't teach you in school. That's right, we're going back to the chalkboard. Anybody else cringe when you think about chalk? Just me? Just that, I don't like it. We're going back to it. We're going back to the chalkboard. Maybe the dry erase board. Let's use that one. Let's modernize this a little bit. So my goal in today's video is to walk through 10 relatively simple, basic ideas that weren't taught to us in school. I feel like this has been a debate since I've actually been in elementary school, probably junior high is when it really started, in terms of like not having enough money management skills in schools. And it's still a problem today. And I don't know exactly why. It feels like it's getting a little bit better, but not nearly as good as it should have been by this point compared to, the decades ago that I was back at that spot. So walk through 10 ideas covering a little bit of everything from home buying, emergency funds, insurance. We're going to walk through 10 really good ideas here. I'm really just going to jump right into it. I've been noted on my last few videos, we used to always have that intro in here. If you're a longtime viewer of the Wealth Keel channel, we have now kicked that out. We just want to give you the content that you're here for. I do put a little plug here now. If you have not subscribed, now's the time to subscribe to the channel. Drop us a comment. Let us know what questions you have. We literally read everything so that we can continue to build content on what you want. So today we're going to get into 10 basics that we missed in school. First one, the American dream, buying your first home. Why do we put this one on here? You're probably thinking, what did they teach me about buying a home in school? Well, this one can go a few different ways, but traditionally, we are taught that you need 20% to buy a home. This is not me defending my millennial generation or the upcoming home owners in Gen Z, but 20% can be a large number considering how much home values have increased over the past few years. Now, where interest rates are where they are today, again, adding context, I don't like to add dates to these videos, but this video is being recorded in mid-2024. Rates a few years ago, extremely low. Rates today, higher compared to then, but historically pretty low still. But we come in thinking that, we need 20% down. And again, I would love for you to get as close to 20% as you can, especially with higher interest rates compared to a few years ago. But it's not feasible for everyone. 20% on a $250,000 home or $1 million home, these are large numbers. No matter what your home buying range is, it's a large number. So just be aware that if you don't have 20%, you can still get a mortgage, and it introduces something called PMI, private mortgage insurance, which isn't the end of the world. And once you hit 20%, the PMI will fall off. So I just don't want you thinking, I've always been told 20%, my parents told me 20%. Remember, our parents bought like 6,000 acres for like 100 grand when they bought their first house. 100 grand for us today is literally what it costs to add, a shed in the backyard. So just keep context to that. Keep your head up. Keep saving money. Save up as much as you can. Leave a little bit of wiggle room in there, right? You don't want to put everything into the home when you buy the home. Then you don't have an emergency fund. You don't even have money to, put window coverings up, but just keep that in mind. So I add a little bit more context on that first one because I feel like that is a hurdle that some feel like they're never going to overcome, but they might not just understand all those moving parts that come with it. Next up, I'm going to go to the opposite way on this one. Save, right? In school or through the grapevine, everyone always says 10%. Now, our main demographic is younger physicians. I would say physicians, I'm always going to give you a higher number regardless because you also had probably an extra 8 extra years of schooling that most others didn't. So you get a little bit of a late start. I've always been a huge advocate for 15 to 20%. I think for the general population, 10% is a low number. So taking it out of the textbook answer, try to save closer to 15 or 20%. And again, I know that that is easier for some, harder for others, but the more you can save, the better. You're never going to look back and say, oh my gosh, I saved too much money. And this doesn't have to be all retirement savings, right? I would argue you want to keep some of this flexible. Maybe it's just building up an emergency fund. Maybe it's what we call, a taxable investment account or a taxable brokerage account that's still accessible with, capital gains tax if you made money, but it's not something that's being locked up for retirement. So number 2 on the list, save. Just make sure you're saving. Just be careful with that 10% number. That can get you in a tough spot if that's kind of the rule you're following for decades upon decades. Next up, the emergency fund. One of my favorite topics. I cannot argue enough on how important the emergency fund is. The stat we threw in our notes here as I was preparing for this video is 40% of Americans can't cover a $400 emergency. Sad. It's not sad in a mean way, but like actually sad, like terrifying that if someone had an expense for $500, they're likely thinking I got to go to a credit card. That credit card more than likely well above 20%, right? That is a terrifying statistic. And this is where we would say personal finance is more personal than it is finance. Don't worry about what your friends have. Just start saving. Put some money aside. Put 50 bucks aside, 100 bucks aside. It depends on where you are, right? A lot of our viewers are physicians. $1,000, maybe Maybe it's more than that, right? Till you hit the number that you're looking for, but put money aside because these moments will occur, right? We all know it's going to happen, right? The car's going to need help. The AC unit's going to go out. There's going to be a leak here. You got to fix this. You got to fix that. You know, the medical bill comes out of nowhere. You got to be prepared for this stuff. So emergency fund, prioritize that. Make that one high on your list. Don't fall into that statistic. Beat that statistic, right? You want to be the other 60% that can cover that emergency, whether it's $400, $4,000. Hopefully it's not much more than that because we'll hope insurance is in play there. But number 3 on their emergency fund. Number 4, budgeting basics. I think budgeting is probably in about 75% of our videos at this point. So it probably emphasizes how important budgeting is, but I don't need you to go create custom Excel spreadsheets, right? That's not what it can be what budgeting is, but it does not have to be. This can be old school. You can go old school pen and paper. There's a lot of great apps out there. We love Monarch, YNAB, You Need a Budget's a popular one. Tiller is another popular one. Track it, right? You need to know what money's coming in, what money's going out. The only way you're going to get better at this stuff is you got to have a budget. You need to track this stuff. So budget, check in on your budget. Monthly, quarterly, semi-annual, annual. The further we go out, I get a little bit more nervous, but you know, me personally, not to say that I have all this figured out. I like a monthly habit of checking the budget for both personal, but also the business side of things, but create a habit that works for you. But number 4 on the list is budgeting. Number 5, the 10th wonder of the world. Is the 9th wonder? How many wonders of the world are there? Compounding interest. So number 5 on our list is compounding interest. Compounding interest is one of those ones where I say so often that I'm like, everyone knows what compounding interest is, but then you find out most people don't actually comprehend that. But compounding interest, in simple terms, is interest on interest, right? You put $1 in there, it gets up to $1.05. Now you're earning interest on your $1.05. Then your $1.05 goes up to $1.10. I don't know if these numbers are right. I'm just adding numbers in my head. It goes up to $1.10. Then you're getting interest on your $1.10. So you're earning interest on interest. Let me give you an example, the one that we have in the notes here. If I could give you the choice between me giving you $3,000 now or a penny that doubles every day for 30 days, which would you take? So again, $3,000 now or a penny that doubles every day for 30 days. I can tell you the most common answer. Everyone says, give me $3,000. Do you know what the penny would have become in 30 days? 10 million buckaroos. That's right, 10 million buckaroos. And most of that happens in the last, I think, 2 to 3 days, right? That's where your doubling is really building up. You know, all of a sudden you go from 5 million to 10 million, and that's how you hit this. So it really happens at the end. But that's the power of compounded interest. There's really no other model to make that any more understandable than that, where if I could give you $3,000 today versus a penny that doubles every day for 30 days, 3,000 versus 10 million. That's the beauty of compounded interest. Now, remember, the stock market doesn't work just like that, right? You don't make $10 million a month, but this is the habit. This is the beauty of creating those savings habits, doing them on repeat, taking emotion out of it, you know, money into the 401k, money into the Roth IRAs, heck, money even into the money market accounts in your savings account, right? You're getting decent interest on that these days. So number 5, compounded interest. Number 6, credit cards. Credit cards get a bad rap because they're often abused because they're probably misunderstood. For example, most credit cards, you don't ever want to go above 30% of your credit limit. That will start to affect your credit score. And the easiest way for a lot of people to get ahead financially is likely increase their credit score. That credit score plays into so many other parts. But for example, if you have a $10,000 credit limit and you don't want to go above 30%, what's that number? 3,000. Back to another 3,000. You don't want to go above $3,000 on that 30% of a $10,000 credit limit, right? So pay attention to those little things. You got to always pay your bill on time. We have some clients that like to pay it monthly because they don't know when the credit agencies are going to actually pull in that balance. So they might actually pay their credit cards twice per month. Pay them on time, use them responsibly, find a credit card that matches up to your points, your goals, and you want to have those paid off at least monthly, maybe again, twice per month, but understand credit cards, utilize them wisely, be smart with them. And you know, we had some comments before in another video. If you know that you can't control that, don't get a credit card. I like credit cards because they give you a little bit more consumer protection compared to like your debit card at the bank, but you also have to know your strengths and weaknesses. So credit cards aren't for everyone. Get a credit card early to start to build credit. Small things, add, just the phone bill to it, right? Let it hit the phone bill, pay that off every month. Credit cards are important. I always make this joke. I probably have said this in a lot of videos with credit cards in them. To me, a perfect credit score is 0, right? You never utilize credit. Unfortunately, that's not the world that we live in. You need to show this credit score for everything, right? Buying a home, a car, a business loan, everything comes back to that credit score. And also a bonus plug here, don't forget to freeze your credit reports. Identity theft is everywhere. It's only going to continue to grow like rapid fire, or as I always say, someone has your information. It's just when are they going to use it? That's how you need to think. But freeze your credit report at the 3 major bureaus. Keep that safe as well. Just a bonus plug in there for our number 6. Number 7, insurance. I'm just going to do 2 basic ones here. I shouldn't say basic. These are very important, but 2 basic ideas here. Term life insurance. If someone depends on your money, you likely need you need term life insurance. Now, you might be able to get this through your employer, through what we call a group plan. You might want to go get private term life insurance. The key is term life insurance. You want to keep that number, you want to keep the premium number as low as possible. Term life insurance will do this. So term life insurance. And the other one, most of our clients are, when I say younger in terms of like when a lot of people look for a financial advisor, might be like the day before they retire. Our clients get to us much sooner, like 30s and 40s. Biggest asset for most of them, the ability to go to work every day for the next 10, 20, 30 years. How do you safeguard this? Something called disability insurance. Most of you watching are probably thinking, oh, that's something I can get through my employer. If you are a high income earner, kind of looking towards my positions here, you likely also need a private policy, which is going to have some better definitions in it, better protection per se, but also allow you to get much higher amounts. So 2 things to keep in mind here: life insurance, disability insurance. Number 8 on the list, taxes. You need to understand taxes. You know, we kind of keep coming back to these things like large bills. One of the largest bills you're going to pay for the rest of your life, year in and year out, taxes. You need to understand how they work. You need to have some basic understandings. You need to get in some tax planning. The higher your income, you likely have larger opportunities. But then I'd also argue the opposite side. The lower your income, you might have better opportunities for different types of tax credits and different types of deductions. So no matter where you are on the spectrum, income-wise, you know, here, make sure you understand taxes. Make sure you're giving enough respect to tax planning. Don't think it's one of those things where I'm just going to send over my W-2 at the end of the year and whatever comes out of TurboTax. It might be that simple if TurboTax is picking up everything, but put some time into your tax planning. That's an important one. Again, that's a huge bill, not only 1 year, every single year, really for the rest of your life. Even when you stop earning income, you're likely going to have taxes, whether it's from your pulling stuff out of the 401k or a pension or Social Security. So pay attention to your taxes. Number 9, guard your health. I'm going to give 2 different things to this. The first one's easy: health insurance, right? Hopefully you're getting this through your employer. Maybe you had to go to the exchange, but health insurance is very important. One, I still believe this is a fact, but the number 1 reason for bankruptcy for most people is actually medical debts that came upon them abruptly. They weren't prepared for that. So medical insurance is really important. I'm also going to put a plug in here for something they didn't teach us in school, but just physical health, right? You could be worth $20 million. If you are not healthy, you likely, 1, can't enjoy it today, and 2, you probably don't have a long duration to enjoy it, right? You're probably going to leave this earth a little bit sooner than you should. So for number 9 on guarding your health here, health insurance is the easy one, but the other one I want in there is just physical health, right? Make sure you're taking care of yourself mentally, physically. Those are really important. If you're going to spend all this time and energy, an entire lifetime building up this number so that you can enjoy your retirement, if you don't have your health, whether that's physically or mentally, what are we doing this, right? What are we doing this for? So number 9, guard your health, both insurance, but then also on the physical, mental side. Last but not least, one they certainly didn't teach you in school, but college debt isn't always necessary, right? Now, again, we work with physicians. You likely have a lot of school ahead of you. You're going to have some college expenses in there. But for a lot of us, there's other ways around. Not saying you don't need college, but there are other ways or lower cost options, right? Community college, lower cost option. Maybe it's a state university, but you're also working on the side. I know it's a lot to balance. I'm not sugarcoating that. Maybe it's some work at the school to help there. Maybe it is taking out a small amount of loans, but not, $100,000, $200,000, $300,000. Just pay attention to college expenses, right? This has been another one where I think it's getting better attention, not as good as where it should be, but it's getting better attention where people are now being a lot more aware, because it is a heavy burden to finish your schooling, to try to go into the real world, to go buy a car, buy a house, set up an emergency fund, do some family planning. Meanwhile, you have a couple $1,000 per month in student loan payments. So just be aware of that. No matter where you're watching this journey or watching this video on your journey, just pay attention to college expenses. Think of other areas around it. We have another video coming out for high income earners on ways to kind of keep those costs low. That should be coming out. It should have just came out actually probably by the time you're seeing this video. So there you have it. 10 items, financial items they did not teach you in school, or they didn't give you enough context to in school. So hopefully these 10 will give you some food for thought, some things to build on. Maybe some of them are already behind you. Maybe some of them are coming up, but 10 things that we should have been taught better in school that we're now trying to learn through YouTube, because YouTube is the ultimate educator these days. So thank you for tuning in here for the last 15 minutes, hanging out with me here for the last 15 minutes or so. If you have not subscribed, please subscribe to the channel. Bell icon will get you notifications every time we release a new video. I know I noted earlier, drop us a comment, drop us a link in our little notes below. In that link, I should say, you can also go to our Google form and also put a more personal note in there in terms of anything you'd like to see, whether it's a question or a topic. We're building this content around you. So thank you again for tuning in. And as always, catch you on the next video.